We are watching the largest oil supply disruption in history, and yet the Nasdaq just hit an all-time high. Is the market brilliant right now, or is it completely blind to the energy wall that AI is about to hit? We really have to forget the software hype of yesterday, because we've entered an era where the digital economy is literally outrunning the physical economy. Just look at this number. On May 13th, 2026, the S&P 500 closed at a record 7,444. The tech-heavy Nasdaq, it surged right past 26,000. Now, this presents us with a pretty profound macroeconomic paradox. At the exact moment those records were broken, the Strait of Hormuz was actually closed due to escalating geopolitical friction. What we are seeing is a complete decoupling of market valuations from physical geopolitical reality. We are witnessing a stark K-shaped divergence in the broader economy. On one side, you have this massive AI infrastructure boom, so semiconductors and cloud utilities are absolutely thriving. But on the other side, the traditional economy, think aviation and everyday retail, well, they're struggling heavily to absorb high fuel costs and sudden supply chain shocks. In fact, the Dow actually fell while the Nasdaq was soaring. The chips that are powering the future are effectively being valued higher than the energy grids keeping our lights on. This isn't just a bubble, it's a structural fracture. And the real catalyst driving this fracture is a decisive move away from software hype into what analysts are now calling the industrial supercycle. This isn't just about training chatbots anymore, right? It's a massive $3 trillion, highly capital-intensive shift to build the physical foundations of intelligence. We're talking gigawatt-scale data centers, custom silicon, and incredibly robust power delivery systems. The infrastructure required to process all this data is quite literally rewriting the hierarchy of global capital.
To really grasp the scale of this technological leap, we just need to look at the transition from the 2025 Blackwell architecture to the 2026 Vera Rubin platform. This is definitely not your standard incremental hardware upgrade. Packed with 336 billion transistors on a single GPU, Vera Rubin delivers a staggering 10x reduction in inference cost. This quietly ushers in the era of agentic AI, where the infrastructure actually has to support continuous, autonomous decision-making. It takes artificial intelligence from being this cool experiment into a capital-intensive, absolutely required utility.
But here's the catch. You cannot process that much intelligence without an incredible amount of memory. 22. That is the terabytes per second of memory bandwidth that the Vera Rubin platform utilizes through its HBM4 memory setup. It is the absolutely critical metric allowing a fully integrated AI factory to even exist in the first place. And it's driving a massive structural boom for memory suppliers. Companies like SanDisk and Western Digital are seeing these margin explosions simply because hyperscalers are suddenly prioritizing sheer capacity and reliability over basic unit cost. Which leads us to a really fascinating realization. Right now, in 2026, the most valuable commodity is in oil. And actually, it's not data either. It's the gigawatt hours required to turn one into the other. We are rapidly transitioning from a digital leap into a very real physical constraint. This entire AI infrastructure supercycle is hurtling straight toward an energy wall. You can build the most advanced silicon on the planet, but it means absolutely nothing if you can't plug it in. The sheer scale of this power demand is honestly unprecedented. Global data centers are approaching 1,050 terawatt-hours of consumption. To put that into perspective, that makes the tech sector a larger consumer of electricity than entire nations, like Japan or Russia. The United States alone requires 92 gigawatts of additional power by 2027. Traditional electrical grid systems simply cannot meet this surge, and interconnection wait times are stretching into years. As a result, the desperate search for behind-the-meter power generation has rapidly accelerated. This looming gridlock is already forcing a massive shift in corporate strategy. If you want to know where the AI trade is actually going, stop looking at the code and start looking at the reactors. Microsoft has pivoted to become the world's largest private AI infrastructure provider by securing its own energy sources. They are literally securing decommissioned nuclear reactors at 3 Mile Island just to power their Azure supercomputers. We are seeing the rise of sovereign energy. These tech giants are building massive defensive moats through vertical integration. They're owning both the chips and the power supply outright. Now, this massive energy sprint is happening against a highly volatile geopolitical backdrop. Beginning back in late February 2026 with Operation Epic Fury, we saw a rapid escalation in the Iran-U.S. conflict, which severely disrupted global energy supply chains. By March 4th, the Strait of Hormuz closed and Brent crude surged past $120 a barrel. Fast forward to mid-April, and a full U.S. naval blockade was in effect. This objective reality of supply chain disruption makes the technology sector's market resilience even more astonishing to watch. The tangible economic impact here is staggering. By May, the Pentagon reported a $29 billion price tag for the conflict so far. But the secondary effects are really where the true pain lies for the global economy. This conflict has fueled an unprecedented energy shock and triggered a grocery supply emergency, with food prices spiking dramatically due to maritime blockades and cumulative crude oil losses nearing 1 billion barrels. Which brings us to the very real macroeconomic reality confronting the new Warsh-led Federal Reserve. We are looking at deeply sticky inflation data right now. We've got an annual producer price index hitting 6.0% and CPI sitting at 3.8%. There is immense institutional tension here. The Fed is basically caught between the market's expectation for rate cuts to maintain liquidity for this massive tech boom and the absolute necessity of managing a 6% spike in producer prices driven by that global energy shock. All of this creates a really profound psychological reality for the investor in 2026. Let's call it inflationary cognitive dissonance. On one hand, you're navigating a high-cost survival economy, watching gas hit $4 a gallon and seeing everyday expenses soar. But on the other hand, you open your brokerage app and see unprecedented technological concentration driving your tech-heavy portfolio to absolute record highs. It's a completely fractured economic experience, one where standard diversification just doesn't feel safe anymore. Yet underlying this entire record rally is a massive structural risk that we call the velocity paradox. This is basically a state where technological hardware investment is massively outpacing operational business readiness. Right now, billions in capital are deployed at the hardware level, but 56% of companies remain stuck in the pilot stage. Actually, look at your own organization. Are you fully deployed or just kind of testing things out? The entire market rally is basically a pyramid balanced on its tip right now, relying on a very thin layer of actual production-grade revenue that just hasn't fully materialized across the broader economy. When we weave all this 2026 data together, we face two highly probable scenarios for 2027. First, we have the monetization wall. If organizations fail to see a clear return on investment, that massive hardware capital expenditure could just evaporate, triggering a severe inventory correction in silicon. Alternatively, we might see sovereign energy nationalization, where governments step in to prioritize AI grid power over consumer grids, literally turning electricity into a strategic geopolitical asset. Both of these scenarios depend entirely on how fast the physical world can adapt to digital velocity. So, as we stand at this historic crossroads, I really want you to consider the strategic paradox we've unpacked today. As we approach that monetization wall of 2027, will the push for sovereign compute permanently decouple digital capital from physical energy constraints, or will our power grid ultimately dictate the limits of human intelligence? It's a fundamental question of architecture versus reality, and how you interpret it will likely define your strategic outlook for the next decade.
An investment in knowledge pays the best interest, so why not invest in this channel? Click like and subscribe for more.